Question 1. An investor living in New York City is considering purchasing a municipal bond issued by the city of Houston, Texas, with a 4.5% coupon rate. If the investor's federal tax bracket is 28%, their New York State tax bracket is 6%, and their New York City tax bracket is 4%, what is the bond's equivalent taxable yield for this investor? A. 6.25%. B. 5%. C. 7.5%. D. 4.5%. Answer: A. 6.25%. The equivalent taxable yield calculation determines the yield a taxable bond would need to offer to provide the same after-tax return as a tax-exempt municipal bond. For a municipal bond purchased by an out-of-state investor, only the federal tax exemption applies, not the state or local exemption. Therefore, the bond's 4.5% coupon is exempt from federal tax, but subject to New York State and New York City taxes. The tax rate for this calculation is 28%, federal, and the formula is, municipal bond yield / 1, investor's federal tax bracket. So, 0.045 / 1 to 0.28 equals 0.045 / 0.72 is equal to 0.0625, or 6.25%. Remember, triple tax exempt status only applies if an investor buys a bond issued within their own state and municipality, which is not the case here. Question 2. Which of the following statements is most accurate regarding the backing of general obligation, GO, bonds? A. They are primarily supported by user fees and revenue generated from specific projects. B. They are backed by the full faith, credit, and taxing power of the issuing municipality. C. They are secured by physical assets, such as the bridges or airports they finance. D. They are primarily guaranteed by the federal government, reducing default risk. Answer: B. They are backed by the full faith, credit, and taxing power of the issuing municipality. General obligation, GO, bonds are considered less risky than revenue bonds because their repayment is secured by the issuer's broad taxing power. This means the municipality can levy various taxes, such as property taxes, income taxes, or sales taxes, to ensure bondholders are paid, representing the full faith and credit. In contrast, revenue bonds rely solely on specific project revenues, like tolls or user fees, making them more speculative. Knowing the difference between GO and revenue bond backing is crucial for understanding municipal bond risk profiles. Question 3. Under MSRB Rule G37, which of the following is considered a municipal finance professional, MFP? A. A registered representative whose primary business is soliciting new issues of municipal securities from issuers. B. A municipal securities dealer executive who oversees only the firm's trading desk and does not directly interact with issuers. C. An employee who primarily handles clerical duties in the firm's municipal bond department. D. A broker-dealer's administrative assistant who processes invoices for municipal bond trades. Answer: A. A registered representative whose primary business is soliciting new issues of municipal securities from issuers. MSRB Rule G37 is designed to prevent pay-to-play practices in the municipal securities industry, specifically restricting business dealings if political contributions are made. A municipal finance professional, MFP, is a key term in this rule, encompassing associated persons who are primarily engaged in municipal securities activities, such as underwriting, sales, trading, or advising municipal entities, or those who supervise such individuals. An executive who primarily solicits municipal bond business from issuers clearly falls under this definition because their role directly impacts a firm's ability to engage in municipal finance business. Understanding who is an MFP is vital for compliance with MSRB political contribution rules. Question 4. An investor purchasing a new issue municipal bond would primarily find details about the bond's purpose, security, and repayment schedule in which of the following documents? A. The official statement. B. The bond indenture. C. The legal opinion. D. The feasibility study. Answer: A. The official statement. The official statement is the primary disclosure document for a new issue municipal bond, serving a similar purpose to a prospectus for corporate securities. It provides comprehensive information about the bond, including the issuer's financial condition, the bond's purpose, its security provisions, and the repayment terms. While a feasibility study assesses project viability and a legal opinion confirms the bond's tax-exempt status, the official statement consolidates all material information for potential investors to make informed decisions. Always review the official statement for critical details before investing in a new municipal bond issue. Question 5. Which of the following municipal bonds would be most likely to be subject to the alternative minimum tax, AMT, for high-income investors? A. General obligation bonds issued for public schools. B. Revenue bonds issued for a public toll road. C. Industrial development revenue bonds, IDRs, used to build a sports arena for a private corporation. D. Public housing authority bonds. Answer: C. Industrial development revenue bonds, IDRs, used to build a sports arena for a private corporation. The alternative minimum tax, AMT, is a separate tax calculation that applies to high-income taxpayers, designed to ensure they pay a minimum amount of income tax. While most municipal bonds are exempt from federal income tax, certain private-purpose municipal bonds, like industrial development revenue bonds, IDRs, where the proceeds primarily benefit a private entity, are considered private activity bonds, and may generate interest that is subject to the AMT. Bonds for public purposes, like schools or public toll roads, generally retain their full tax-exempt status. Always check if a municipal bond is designated as an AMT bond, if you are subject to the alternative minimum tax, as this can affect your after-tax yield. Question 6. A municipal bond is quoted as 6.50 basis. If the bond has a 6% coupon and matures in 10 years, what does this quote indicate? A. The bond's coupon yield is 6.5%. B. The bond is trading at a premium. C. The bond's yield to maturity is 6.5%. D. The bond's current yield is 6.5%. Answer: C. The bond's yield to maturity is 6.5%. Municipal bonds are typically quoted in basis points, which refers to their yield to maturity, YTM. A quote of 6.50 basis means the bond's yield to maturity is 6.5%. Since the bond's coupon rate, 6%, is lower than its yield to maturity, 6.5%, it indicates that the bond is trading at a discount. If a bond's YTM is higher than its coupon, it means the bond is selling below par. Always remember that a basis quote refers to the bond's yield to maturity, which is the most comprehensive yield measure. Question 7. An investor residing in Miami, Florida, purchases a municipal bond issued by the City of Miami. Which of the following tax exemptions would apply to the interest received from this bond? A. Federal income tax only. B. Federal and Florida state income tax only. C. Federal, Florida state, and local, Miami, income tax. D. No tax exemption, as municipal bonds are generally taxable at the local level. Answer: C. Federal, Florida state, and local, Miami, income tax. When an investor purchases a municipal bond issued by a municipality within their own state and, if applicable, their own city or local jurisdiction, the interest income is generally exempt from federal, state, and local income taxes. This is often referred to as triple tax exempt status and is a significant benefit for residents of high-tax states and cities. For this Miami resident buying a Miami bond, the interest avoids all three levels of taxation, making the after-tax yield very attractive. This triple tax exemption is a key selling point for in-state municipal bonds. Question 8. What is the primary purpose of the legal opinion accompanying a new municipal bond issue? A. To guarantee the bond's credit rating. B. To certify the bond's marketability and liquidity. C. To attest to the bond's validity and tax-exempt status. D. To provide a detailed financial analysis of the issuer's debt capacity. Answer: C. To attest to the bond's validity and tax-exempt status. The legal opinion is a critical document provided by bond counsel for a new municipal bond issue. Its primary purpose is to confirm that the bonds are legally valid, issued in accordance with applicable laws, and that the interest income is indeed exempt from federal income tax. Without a positive legal opinion, a municipal bond would be highly unattractive to most investors due to uncertainty regarding its tax-exempt status. This opinion is essential for the bond to be considered a bona fide municipal security. Question 9. Which of the following best describes the tax treatment of Build America bonds, BABs, issued by municipalities? A. Interest on BABs is fully tax-exempt at the federal, state, and local levels. B. Interest on BABs is taxable to the bondholder, but the issuer receives a federal subsidy for a portion of the interest paid. C. Interest on BABs is subject to the Alternative Minimum Tax, AMT. D. BABs are entirely tax-exempt at the federal level but fully taxable at the state and local levels. Answer: B. Interest on BABs is taxable to the bondholder, but the issuer receives a federal subsidy for a portion of the interest paid. Build America bonds, BABs, were a special type of municipal bond authorized under the American Recovery and Reinvestment Act of 2009 to help stimulate the economy. Unlike traditional municipal bonds, the interest paid on BABs was taxable to the bondholder. However, to compensate for this, the U.S. Treasury provided a direct payment subsidy to the issuing municipality, covering a significant portion of their interest costs. This made BABs attractive to a broader range of investors, including those in lower tax brackets or tax-exempt entities, who might not benefit from the traditional tax exemption. BABs were a temporary program and are no longer issued, but existing ones still trade. Question 10. In the secondary market, what is the standard par value unit for quoting and trading municipal bonds? A. $100. B. $1,000. C. $5,000. D. $10,000. Answer: B. $1,000. Just like corporate bonds, municipal bonds are typically issued and traded in increments of $1,000 par value. Therefore, when a municipal bond is quoted at a certain price, example 98 or 102, that price is a percentage of the $1,000 par value. For instance, a quote of 98 means $980, and a quote of 102 means $1,020. This standard par value makes it easier to understand bond pricing and compare different bond issues. Question 11. A municipal bond issue backed by a pledge from the state legislature to make up any deficiencies in debt service from future appropriations, but without being a legally binding obligation, is known as A. Revenue bond. B. General obligation bond. C. Moral obligation bond. D. Insured bond. Answer: C. Moral obligation bond. A moral obligation bond is a municipal bond backed by a pledge from a state or local government to make up any debt service shortfalls, but this pledge is not legally enforceable. While the state's moral commitment suggests a high likelihood of payment to avoid reputational damage, it's not an unconditional guarantee like a general obligation bond. This implies a slightly higher risk than a GO bond but potentially lower than a pure revenue bond, as there is a strong incentive for the state to support the bond. Question 12. Which of the following is considered overlapping debt for a general obligation bond issued by a city? A. Debt issued by a state authority for a statewide project that includes the city. B. Debt issued by a county school district that partially includes the city. C. Debt issued by a neighboring city within the same county. D. revenue bonds issued by the city itself for a local utility project. Answer, B. Debt issued by a county school district that partially includes the city. Overlapping debt, also known as coterminous debt, refers to municipal debt issued by multiple taxing authorities that draw revenue from the same geographical area. For example, if a city's residents are also taxpayers for a county, a school district, or a sanitation district that overlaps with the city, then the debt of those overlapping entities is considered overlapping debt for the city's general obligation bonds. This is significant because it represents the total debt burden on the taxpayers within the city, which is crucial for assessing the financial strength of the city's GO bonds. Question 13. When calculating accrued interest for a municipal bond, which day count convention is typically used? A. Actual days in month/actual days in year. B. 30-day month/360-day year. C. Actual days in month/365-day year. D. 30-day month/actual days in year. Answer, B. 30-day month/360-day year. Accrued interest on municipal bonds, similar to corporate bonds, is calculated using a 30-day month and a 360-day year convention. This means each month is treated as having 30 days, regardless of its actual length, and the year is assumed to have 360 days. This simplifies the calculation of interest that has accumulated since the last payment date but has not yet been paid to the bond seller. Always use the 30/360-day count method for municipal and corporate bond accrued interest. Question 14. A municipal bond with bond insurance typically receives which of the following benefits? A. A higher yield, reflecting the increased risk. B. A lower credit rating, indicating the insurer's liability. C. Enhanced marketability and a higher credit rating. D. Exemption from federal income tax, regardless of the issuer. Answer, C. Enhanced marketability and a higher credit rating. Bond insurance is a guarantee provided by a third-party insurer that ensures timely payment of principal and interest to bondholders, even if the issuer defaults. This insurance effectively substitutes the insurer's credit rating for the issuer's, typically elevating the bond's rating to AAA. Consequently, insured bonds have enhanced marketability and can be sold at a lower yield than an uninsured bond from the same issuer, benefiting both the issuer, lower borrowing costs, and the investor, reduced risk. Question 15. A registered representative is recommending a municipal bond to a client. Which of the following factors is least important when determining suitability? A. The client's state and local tax brackets. B. The client's investment objectives and risk tolerance. C. The bond's reoffering yield in the primary market. D. Whether the bond's interest is subject to the alternative minimum tax, AMT. Answer, C. The bond's reoffering yield in the primary market. When determining suitability for a municipal bond, a registered representative must prioritize factors directly related to the client's financial situation and investment goals. The client's tax brackets are critical for assessing the tax-exempt benefits, and their objectives and risk tolerance are fundamental for any investment recommendation. Likewise, if the bond's interest is subject to AMT, it significantly impacts the after-tax return for certain high-income clients. While the reoffering yield is important for pricing, it's a market-driven factor and less directly relevant to the client's individual suitability compared to their tax status, risk profile, and investment needs. Question 16. When analyzing the creditworthiness of a general obligation, GO, bond, an analyst would most closely examine which of the following? A. The feasibility study for the project being financed. B. The issuer's total debt, including overlapping debt and debt limits. C. The projected user fees and revenues from the specific project. D. The historical performance of similar revenue bonds. Answer, B. The issuer's total debt, including overlapping debt and debt limits. The creditworthiness of a general obligation, GO, bond is primarily assessed by the issuer's overall ability to tax and repay its debt, not by specific project revenues. This involves analyzing the issuer's comprehensive debt burden, including net direct debt, overlapping debt from other taxing authorities in the same area, and any statutory or constitutional debt limits that restrict the municipality's borrowing capacity. These factors directly reflect the municipality's financial health and its capacity to meet its bond obligations. Question 17. An investor concerned about their after-tax yield on a municipal bond would be most interested in a bond with which of the following characteristics? A. A lower coupon rate but higher current yield. B. Issued by a public university for dormitory construction. C. Issued by a state authority for a public park. D. Issued by a local authority for a new factory to be leased to a private corporation. Answer: D. Issued by a local authority for a new factory to be leased to a private corporation. An investor focused on maximizing their after-tax yield would generally seek municipal bonds whose interest income is fully exempt from federal, and potentially state and local, income taxes. Bonds issued for public purposes, like university dorms or public parks, typically offer this full tax exemption. However, bonds issued for the primary benefit of a private corporation, such as an Industrial Development Revenue Bond, IDR, used to build a factory leased to a private company, are often considered private activity bonds. The interest on these private activity bonds may be subject to the alternative minimum tax, AMT, for some investors, which reduces their after-tax yield. Question 18. Where would an investor find current trade data, disclosures, and official statements for municipal securities in the secondary market? A. The Consolidated Tape Association, CTA, system. B. The Electronic Municipal Market Access, EMA, system. C. The New York Stock Exchange, NYSE, bond listings. D. The OTC Markets Group Pink Sheets. Answer: B. The Electronic Municipal Market Access, EMA, system. The Electronic Municipal Market Access, EMA, system is the MSRB's, Municipal Securities Rulemaking Board, official repository for municipal securities data. It provides free public access to official statements, ongoing disclosures from municipal issuers, and real-time trade data for municipal bonds. This centralized platform ensures transparency and accessibility for investors and professionals in the municipal market, making it the go-to source for information on municipal securities. Question 19. In a competitive bid municipal bond underwriting, the winning underwriter is typically chosen based on A. The lowest net interest cost to the issuer. B. The highest reoffering yield for investors. C. The most extensive distribution network. D. The firm's long-standing relationship with the issuer. Answer: A. The lowest net interest cost to the issuer. In a competitive bid municipal bond underwriting, multiple syndicates submit sealed bids to the issuer. The issuer typically awards the bond issue to the syndicate that offers the lowest net interest cost, NIC, which represents the overall interest expense the issuer will pay over the life of the bond. This method ensures that the municipality obtains the most favorable financing terms. Conversely, in a negotiated underwriting, a single underwriter is chosen directly, often based on relationships and their ability to help structure the deal. Question 20. Which of the following would be the most significant concern for a municipal bond analyst evaluating a general obligation, bond from a city with a high level of unfunded pension liabilities? A. The bond's call features. B. The city's ability to raise property taxes to cover the liabilities. C. The potential for the city to default on its pension obligations, diverting funds from bondholders. D. The bond's moral obligation pledge from the state. Answer: C. The potential for the city to default on its pension obligations, diverting funds from bondholders. Unfunded pension liabilities represent a significant and growing financial strain on many municipalities. For general obligation, bonds, which are backed by the full faith and credit, including taxing power, of the issuer, high unfunded pension liabilities pose a direct threat. If a city faces severe financial distress due to pension shortfalls, it might be forced to divert resources, including tax revenues, from other obligations, potentially impacting its ability to service its GO bond debt. This effectively increases the financial risk for GO bondholders. Question 21. An investor purchases a new issue municipal bond at a premium. For tax purposes, how must this premium be treated? A. It is deductible in the year of purchase. B. It must be amortized annually over the life of the bond, reducing the bond's cost basis. C. It is ignored, as municipal bond interest is tax-exempt. D. It is capitalized and recovered only at maturity or sale. Answer: B. It must be amortized annually over the life of the bond, reducing the bond's cost basis. For tax purposes, if a municipal bond is purchased at a premium, the premium must be amortized, written off, annually over the life of the bond. This amortization reduces the bond's cost basis each year, but it is not a deductible expense against ordinary income. The amortization ensures that if the bond is held to maturity, the adjusted cost basis equals the par value, resulting in no capital loss at maturity. This rule prevents investors from deducting the premium and is crucial for accurately calculating capital gains or losses upon sale. Question 22. A new issue municipal bond is sold with an original issue discount, OID. How is this OID typically treated for federal income tax purposes if the bond is held to maturity? A. The discount is taxable as ordinary income each year as it accretes. B. The discount is taxable as a capital gain at maturity. C. The discount is tax-exempt as it accretes, increasing the bond's cost basis. D. The discount is treated as taxable interest income at maturity. Answer: C. The discount is tax-exempt as it accretes, increasing the bond's cost basis. For municipal bonds issued with an original issue discount, OID, the discount is considered part of the tax-exempt interest earned on the bond. The OID must be accreted annually over the life of the bond, and this accretion is tax-exempt for federal income tax purposes. This annual accretion increases the bond's cost basis, ensuring that if the bond is held to maturity, there is no taxable capital gain at maturity. This treatment is a significant benefit for OID municipal bonds. Question 23. An unconfirmed bid for municipal bonds, which may be adjusted slightly before becoming a firm offer, is known as A. Firm bid. B. Workable bid. C. Nominal quote. D. Bid wanted. Answer: B. Workable bid. In the municipal bond market, a workable bid is a dealer's indication of a bid price for a block of municipal bonds, but it is not a firm bid. It indicates a price at which a dealer believes they could work to sell the bonds to another party, implying that the actual bid might be slightly adjusted once a definite buyer is found. This differs from a firm bid, which is a concrete offer to buy at a stated price. Understanding these subtle differences in interdealer quotes is key to navigating the municipal secondary market. Question 24. Which of the following revenues is not typically used to back a general obligation, GO, bond? A. Ad valorem taxes on real estate. B. Sales taxes. C. Specific user fees for a toll road project. D. Fines and licenses. Answer: C. Specific user fees for a toll road project. General obligation, GO, bonds are backed by the full faith, credit, and taxing power of the issuing municipality. This means they are repaid from general revenues, which commonly include ad valorem, property, taxes, sales taxes, income taxes, and various fines and licensing fees. Specific user fees, such as tolls from a toll road, are typically the revenue source for revenue bonds, which are repaid solely from the income generated by the specific project they finance. This distinction is fundamental to understanding the backing of different municipal bond types. Question 25. An investor comparing two municipal bonds, one with a 4% coupon and a 4.2% yield to maturity, and another with a 4.5% coupon and a 4.3% yield to maturity, should note which of the following regarding their pricing. A. Both bonds are trading at a discount. B. Both bonds are trading at a premium. C. The first bond is trading at a discount, and the second bond is trading at a premium. D. The first bond is trading at a premium, and the second bond is trading at a discount. Answer: C. The first bond is trading at a discount, and the second bond is trading at a premium. A bond trades at a discount when its coupon rate is less than its yield to maturity, YTM, meaning the market demands a higher return than the coupon provides. Conversely, a bond trades at a premium when its coupon rate is greater than its YTM, indicating the bond's income stream is more attractive than current market yields. In this scenario, the first bond, 4% coupon, 4.2% YTM, is at a discount because its coupon is lower than its YTM, while the second bond, 4.5% coupon, 4.3% YTM, is at a premium because its coupon is higher than its YTM. Always remember the relationship: if coupon YTM, it's a discount; if coupon YTM, it's a premium.